Tax season is always a busy time for accountants. But this year, the complexity and confusion around COVID-19 relief programs have made it even more challenging. In particular, the Employee Retention Credit, also commonly known as ERC, has been a source of frustration for many accountants and their clients. But why is that? And why are we still talking about it 2 years after the COVID surge? In marketing, we talk about early adopters, the people who are quick to try out new products or services. They tend to be tech savvy, open-minded, and willing to take risks. Now, that definitely doesn't describe most accountants, and that's okay. You are cautious, detail-oriented, and methodical. Because unlike someone rushing to get the latest iPhone, when you are trying to chase a quick dollar, as an accountant, there are very real and very legal consequences. You have to deal with the US government or a litigious client blaming you for their mistakes because they trusted some unidentified caller asking about ERC instead of you. Early adopters are great for business because they help generate buzz and excitement around a new offering. But when it comes to tax credits like the ERC, businesses need accountants who are thorough, meticulous, and most importantly, ethical. They need someone who will take the time to understand the eligibility criteria, document and maintain records, and be aware of mistakes that could lead to penalties and additional taxes owed. That is not an early adopter. The first fraud indictment for false ERC claims was issued on February 1st of this year, which means that we have a lot more fraud claims to get through before we are out of this mess. Just to make sure we are all on the same page, the ERC tax credit promoted by the US government in response to the COVID-19 pandemic to help businesses retain their employees. It's a complex process full of pitfalls that led to mistakes, fraud, and general frustration. So I've decided that the 3 C's of the ERC are challenges, controversy, and confusion. There are tons of confusion surrounding the filing process itself. The first, most common mistake is not fully understanding the eligibility criteria and the requirements for claiming the credit. This might not be entirely on accountants and business owners, but we'll cover that a little later. Another frequent mistake is failing to document and maintain accurate records of employee wages and hours worked. If you don't have the documents to back up your client's claims, you're better off not applying for the credit at all, especially with all of the recent scrutiny. Think about how much a lawsuit from a disgruntled client would cost. And last but not least, there's the issue of questionable overlap between the ERC and other COVID relief programs like the Paycheck Protection Program, commonly known as PPP. Now, this next part may seem a little obvious, but we're covering our bases, even though the IRS oftentimes does not. So, how do you ensure that your clients meet the requirements for an ERC? The first thing you need to determine is whether your client is eligible for the Employee Retention Credit. To be eligible, they need to meet the following requirements. Number 1, they must have carried on a trade or business during the calendar year in which the credit is claimed. Number 2, they must have experienced a significant decline in gross receipts due to the COVID-19 pandemic. Number 3, they must not have received a Paycheck Protection Program loan. If they check all these boxes, you've crossed off the first set of obstacles. But you're not out of the woods yet. There's been a ton of confusion surrounding exactly how much the Employee Retention Credit will pay out. It's best not to give a specific number to your clients, but if you want to offer an estimate, here's how you calculate it. And I would still recommend, just to be clear, that you provide a range so they aren't disappointed if the credit ends up being less. The credit is equal to 50% of qualified wages paid to each employee up to a maximum of $10,000 per employee. The qualified wages include wages paid between March 12th, 2020 to December 31st, 2021. The amount of the credit is also dependent on the number of employees. This part will not be applicable to the majority of the clients you have. If your client had more than 500 employees in 2019, the credit only applies to wages paid to employees who are not working during the quarter in which the credit is claimed. Now, what does definitely apply to you, if your client had 500 or fewer employees in 2019, the credit applies to all wages paid during the quarter. Finally, last but certainly not least, to apply for the credit, you will need to complete Form 941 for the quarter in which your client paid the qualified wages. You will then need to reduce your client's payroll tax liability by the amount of the credit and report the credit on the Form 941. And then you're home free, or are you? Believe it or not, ERC opportunities are the new controversy in the accounting world. We're actually putting Sam Bankman-Fried and FTX on the back burner just for now, because there's more coming out on that later. Because this process is new and relatively undefined, it can lead to unintentionally false tax claims, which puts you, accountants, in a difficult position. You want to help your clients save as much as possible on their taxes legally, but you also want to avoid any legal or ethical issues. But that's you. There are plenty of others out there who are not interested in working within legal or ethical boundaries. Talk to your clients. Warn them about the scams that surround employee retention credits. Tell them if someone is shoving ERC opportunities down their throat and pressuring them to apply, don't do it. That is a huge red flag. In this arena, you don't want to be an early adopter. You want to make sure that your client's assets and your reputation as a reliable accountant are protected. There has been a huge uptick in falsely filed ERC claims, some because of predatory scams, and others might just be the fault of the IRS, if you can imagine that. As with most things related to the IRS, all of the things discussed today could fall under the category of a challenge. But unfortunately, with the ERC specifically, there are more issues than normal. Because even with the best of intentions, you can go wrong with ERC. Remember those eligibility requirements I mentioned a few minutes ago? Well, there's one more that the IRS forgot to add until it was too late. I actually stumbled on a really interesting Twitter thread discussing this exact issue a few days ago. Shout out to Dan Choden for putting together a fascinating look at the cause of all of the ERC issues and who is to blame. Looking at the fraud indictments, Dan noticed something interesting. The majority of fraud accusations are small-time claims by business owners who thought they were within the legal requirements. How did this happen? Long story short, independent contractors were convinced that they should convert to an S Corp, create wages for themselves, and then claim the employee retention credit. Who convinced them that this was a good idea? An accounting firm, if you can believe that. Cost Accounting, COS Accounting to be clear, which according to their LinkedIn profile specializes in S Corps, ironically, LLCs, and saving thousands on taxes. They ran a campaign to encourage small business owners to use this S Corp loophole to claim the employee retention credit. They were the first to get their hands caught in the proverbial cookie jar, and they won't be the last. Unfortunately, many other accountants and CPA firms did the exact same thing. You can find plenty of examples of this scammy and predatory behavior with a quick YouTube search. But by August of 2021, these scams had slowed significantly. And if you're wondering why, it's because IRS Notice 2021-49 was issued. And it contained one last and very important qualification. IRS Notice 2021-49 says owners are not eligible for ERC. Remember, ERC, Employee Retention Credit. Oh, so strange that owners would not qualify for something called Employee Retention Credit. Imagine that. This is a symptom of a larger problem. The ERC is just one example of a tax code that is too difficult for the average Joe, and so complex that it creates unintentional loopholes. It's not just frustrating for the frontline accountants of the world. It's frustrating for businesses as well. We need a better system, one that is simpler and easier to understand. And until we have that, accountants will continue to be put in the middle of a battle between their clients and unintentionally false tax claims. Because although these scams are definitely scams, if this tax code had been more thorough and clearly stated that business owners would not be eligible for ERC, there would be a lot fewer fraud indictments on the calendar for 2023. Now, just in case my stance is unclear on this behavior disgusts me. For now, accountants can take pride in the fact that they are not early adopters, and they shouldn't be. It wasn't until August 2021, a full year after COVID, that the IRS clarified its rule about business owners. If you were early on helping your clients access ERC, you were put in a difficult position by an incomplete tax code. Instead of early adopters, aim for the early majority. Be the careful, detail-oriented, and methodical group who wants to mitigate risk while still being able to stay ahead of the curve. And that's exactly what businesses need when it comes to navigating the complex world of tax credits, advisory, and relief programs. Your clients do not need you to be an early adopter, but they do need you to be aware of tax saving strategies. Believe it or not, it's a pretty easy balance to strike. If something looks like a loophole, it probably is a loophole. The IRS will eventually close it and penalize you and your clients. You can stay ahead of tax savings without adding any risk by staying informed. You know the tax code, so you know when something seems sketchy. Trust your instincts. There is no such thing as an emergency in accounting. There is, of course, urgency with deadlines and due dates, but that's different than an emergency. Extensions exist, and you have the option to refile. Moving a little slower lets you gain traction and make sure you're making the right move. Worst case scenario, your clients receive their employee retention tax credit a few months later. Best case scenario, you avoid jail time and help them avoid a federal fraud indictment. Accounting wasn't made for early adopters, and accountants should not be a group that experiments with the latest and greatest. You and your firm and your clients will be better off working thoughtfully and methodically. This was a little bit different than what we normally do on this channel. If you like this particular style of content, please be sure to like this video and subscribe to our YouTube channel. And most importantly, if we got anything wrong, we want to know. Let us know in the comments section if we did something right, or ultimately if there's something that we could have done a little bit better and we'll do better the next time around. My name is Tyler S. Clark. Thank you so much for investing your most precious resource with us. And remember that only you can create your dream firm, but we are here to help you every single step of the way. Have a fantastic rest of your workday. And remember, if it smells like a scam, it probably is one.